When you start investing, it's interesting to see that when you start thinking of the first 100,000, let alone the first 10,000, it is really overwhelming, and it can be overwhelming for a lot of investors, which is the reason why I'm going to be covering some strategies for really beginner investors to make that first $100,000. Now, when you think of, Charlie Munger, when you think of Warren Buffett, when you think of the first $100,000, they always say it is the absolute most difficult to get to because, of course, when you're under the $100,000 mark, you really don't feel a lot of the compounding interest until you start getting into the higher balances. Because when you start thinking of the stock market, even going up 3-5%, if you have $10,000 in there, going to be a little bit increase. When you get 100,000, when you get $1 million in there, the 3 to 5% can make a really big difference in changing the balances that you have here. Now, of course, with the live stream, and I think it's still live, it's giving me an error over here. I think it's still good. Sorry about that. But of course, with live stream, if you have questions, absolutely just go ahead and drop them into chat if you have any questions at all. And again, I think it's working through StreamYard. So if it is, definitely drop a comment in there. We're going to go through 8 different strategies. And really, this is the fundamentals. When it comes to making that first $100,000, there are some fundamentals. And starting with number 1, setting clear goals. This is really defining your goals. Why do you want to get to that $100,000 mark? What is it going to look like? What exactly is going to be the life changer for you? And how are you going to get there? This, of course, entails a time horizon. So specifically looking, hey, I want to save $100,000 in the next 5 years, 10 years, whatever it may be, but you know the time horizon. If it's in a retirement account, you know exactly where you want to be. And you also have to keep in mind, how much risk are you willing to take when it comes to hitting that horizon? This, of course, is really important because if you're taking and investing in things that you don't know, like cryptocurrency or real estate, chances are you could have a lot more risk than you really know in general, especially not knowing. Now, I really live by and stand by, do not invest into anything that you don't know what it is. Do not invest into anything that you do not understand, which again, really goes hand in hand when it comes to crypto and investing itself. You have to know where you're putting your money in. So investing goals, setting a time frame, really building a SMART goal. And if you're unfamiliar, specific, measurable, attainable, timely, and relevant, really looking at, and I think I might have put those last 2 backwards, but looking at a SMART goal, you want to make sure the more details that you put into it, the more clear, really define the goal is going to be. Know exactly what you want to achieve and how you're going to get there with the investment choices. Because honestly, when you think about making $100,000, it is going to be much easier if you're putting money into an investment account over time versus trying to just save $100,000 in a savings account that is not yielding any return. But of course, before we get into the investing aspect, number 2, paying off the high interest debt. When you think about your high interest debt, we're looking at your unsecured loans, we're looking at your bad debt, we're looking at your credit cards. When you start looking at the interest rates that you're paying in there before investing, the high interest rate has to be done and has to be gone. When you look at a majority of credit cards running 20 to 25% interest, there's not many places in the market that you're going to see 20, 25% guaranteed return, or literally everyone would be investing in those. But when you start looking at the high interest debt, you are guaranteed to be paying that debt because, of course, that is the interest rate that you are paying on your credit card. And if you're carrying that debt, it is absolutely crushing you. The way that you have to see it, and it was really probably about 10 years ago that my mindset really changed when it came to high interest debt, and really the way that I view it when I became a financial counselor. Really sitting down and looking at credit card debt. And when you think of all the money you're making in minimum payments, what you're paying in interest, it is money that every single dollar you're paying in interest, every single dollar that you're giving to companies is money that you can't invest, money that is not going to go into an emergency fund, that's not going to be building up a future you. It is really paying for things that are in the past, especially with credit cards. If you're sitting on, let's say, for instance, $10,000 in credit card debt, looking at the minimum payment, but when you get your statement and it reads, hey, it's going to take you 15 years to pay off this debt if you're making the minimum payments. In the credit card world, that is kind of crazy to think that they drag them out that far, but it is also kind of crazy that everything that you're paying for today are things that you purchased in the past, which means future you, of course, is not getting any benefit from it because it is things that you really did in the past. Now, in addition to not only the high interest debt, it also usually comes with a high, very high amount of stress, really financial stress from carrying that debt. Because of course, as the balances, and if they continue to get higher, the minimum payments get higher, the interest you're paying on those cards starts to exponentially get higher and higher. Number three we look at is building an emergency fund. Now, a lot of people ask me, why an emergency fund? Now, of course, if you pay off your high interest debt, taking the money, and again, these are steps we're doing before we're investing, before we're goaling out, before we're planning to that $100,000 mark. But if you start building up that emergency fund after the high interest debt is paid off, it is going to give you the ability to not have to borrow, which means you're not going right back into those credit card debt. You're not going right back into debt in general, whether it is unsecured, whether it's credit card debt. You want to make sure that that emergency fund also is used for an emergency. You know, there is a lot of individuals that really have the justification of what an emergency is. An emergency could be, hey, I have to take a trip with my family to go to Disney. I'm going to use some of that emergency fund and I'm going to replenish it with the best of intentions. But a lot of times the emergency fund doesn't get replenished. And again, when you start thinking of what a true emergency is, this is looking at your car is broken down. This is, you know, you need a furnace. You need something that is unexpected, is really calculated as an emergency. You lose your job. There is an unexpected illness, sickness, whatever it is. Now, these funds are also built in there as that emergency fund to keep you from having to liquidate assets and really looking at, regardless of where the market is. For instance, I had an individual today that said, hey, I have an emergency. I don't have any money. I want to pull $2,500 out of my Roth IRA. Okay, we can do the withdrawal for you, but is there a better way to get it? Because again, not building up that emergency fund makes a big difference. And now you're sacrificing the future you and the market gains. Looking at the future value that a Roth IRA could provide is not going to be there because she's pulling out the money. Not only paying penalties to take money out of CDs, but also paying penalties for early withdrawals. Again, kind of based on that. Now, again, I know a lot of the Roth have a lot of different rules, a lot of different taxation things, but depending on if she's taking out her contributions or gains, you could also be subject to a penalty there as well, which again is going to be kind of crazy to think. But money for retirement is for retirement, and that is where the money for retirement has to really stay. Now, number four, we get into diversification of your portfolio. Now, when you start thinking of diversification, this is where, of course, one of my absolute favorite things come in. Even looking at number 5 on this list of the 8 reasons or 8 really methodology strategies to build that $100,000 is when you look at number 5, investing in low-cost index funds or ETFs. Now, diversification in ETFs, diversification in index funds really do kind of go hand in hand as long as you're putting it into ETF funds that offer diversification. So some of these funds include the VOO, which is the Vanguard S&P 500. When you're putting money into this fund, it is instantly diversified because you're investing in the 500 largest companies in the United States. Those are across all sectors that we have within the stock market. And of course, you are owning a bunch of different companies. It is not going out there and buying Apple and buying Nvidia and buying, Microsoft individually. It is owning, and again, instant diversification can come from ETFs, but there are, and you have to be careful because there are ETFs that are very, very specified that don't offer the same level of diversification. But if you followed my videos for a little while, and if you've seen the 3-fund portfolio, absolutely you can have instant diversification with those ETFs. Now, of course, with diversification, it is a broad market exposure, have a lower fee than the managed funds with ETFs. This is the reason why I do not do, or why the reason that I focus on those ETFs versus the mutual funds. When you look at the mutual funds, they are managed funds. Those managed funds are a lot more expensive than we have with the ETFs. And a lot of those are in very similar, if not the same products that we see. Even looking at ETFs or looking at those index funds, they usually run about a 0.05%, which, I mean, when you start thinking fractionalized $5 for every $10,000 that you have invested, it's kind of crazy that they are this low for those ETFs. Then when you start getting into those mutual funds, which I know Dave Ramsey and a lot of advisors do really offer or want to push, the reason is there is a fee that comes with it. There is a 1% fee. There is a 1.5% fee, depending what you're putting your money into and which mutual funds you're really investing in. There can be a fee. Now, fees may not seem that high at 1%, but then when you extrapolate it over a 30, 40-year period, you're looking at about 30% of your entire portfolio that can be eaten up by fees, which is, again, the same reason why I don't really push the idea of financial advisors. When you can go in there, put everything into just simply one ETF like the VOO, get roughly the 10% annualized return over 40 years, and your investments will be sitting pretty as long as you're making your contributions on a regular basis. Now, in addition, when you think of your portfolio, the three fund, and I want to cover it real quick, is number one, I look at kind of the foundation. This is your VOO, your VTI. There's a bunch of different companies that offer kind of the same financial ETFs, and just kind of the foundational piece of it. Then I look at a part that is going to be your growth ETF. Now, looking at the VUG from Vanguard, looking at the QQQM from Invesco, there are a lot of ones that are going to be kind of the growth ETFs overall, which is going to be, if you're a younger age, you want a lot of growth. If you have a good runway, 20, 30, 40 years, runway until retirement, you're going to want a lot more exposure to the market, a lot more exposure to the tech sector because of the growth. And the third one, of course, we focus on is the dividend income. This is the VYM, the SCHD. And again, these ETFs that I'm naming are just specifically what I invest in personally. There's a lot of different companies that have very similar, if not the same ETFs that are tracking the exact same indexes that we see from some of these other funds. Now, when we get into number 6, this is the game changer. This is the number one most important thing that you guys have to focus on: maximizing retirement contributions. Now, when you think of the diversification of your portfolio, when you think of investing into those ETFs, taking full advantage of retirement accounts, when you look at 401ks, if you're getting a match, it is free money. Majority, and I believe the average that they said from Vanguard was 5%, was the average company match that they've seen across the board. So if you're not at a very, very bare minimum getting that company match, you're leaving free money on the table. And the money you're leaving on the table is essentially what they have given you as one of the benefits for your job. So you are not taking advantage of the full benefits package that your employer offers because you're not taking that employer contribution, which of course is free money. Now, in addition to the employer contributions, this is where it can get a little bit tricky, because when it comes to the 401ks itself, it is going to be very dependent on what you can invest your money in. Now, some 401k providers provide really a really broad market exposure, a lot of different investment strategies that you can do. So working with a financial advisor through your 401k plan, and most of them do offer it for free, but depending on what it looks like for what you can actually invest in, I have also seen 401k plans that are not really worth the investment. Short of getting that matching contribution from your employer, it is not really worth the contributions because of what they're putting the money into. And then, of course, when it comes to our IRA accounts, when it comes to any retirement funds, these have to be invested. I cannot stress that enough. I know a lot of individuals that have larger IRA accounts. They're housing them at your Chase, your Bank of America, your Comerica, your Fifth Third. They're sitting at financial institutions. They're not investing in the market. They are not growing how they need to be. Some of those are paying literally like a 0.30. So you're talking a third of a percent that you're getting on an investment account. The IRA money has to be in something. And of course, I do have links down below for M1 Finance. They have IRAs and investable IRAs into the market. So if you're putting money and making contributions into an IRA regularly, if you think, throwing money into your IRA account, if it is in an investable account, it will invest automatically in the IRA based on the designation that you're putting into. And again, looking at ETFs, thinking of the VOO, you can absolutely be putting money into there. And what is going on? Kooky is joining us. Thank you for joining us for the stream. I love doing the financial streams. I've been trying to get back to it, doing it at least once or twice a week with the videos, kind of incorporating all in there. And of course, we are trying to make the $100,000, just like I know Kooky wants to do as well. Getting that $100,000 in the first 100,000 is the hardest, of course, because of the compounding interest that we see. Now, number 7, we get into the advisors and the robo-advisors. Now, if you don't want to do your own research, like we said earlier, you don't want to invest in anything that you don't know about. It is really imperative. You have to know what you're investing into. However, if you choose not to learn about it, if you choose, you don't want to spend the time, you don't want to spend the effort, you don't want to do anything, You can get robo-advisors, you can get ETFs, you can also pay an advisor if you don't want to do any of the investing yourself, which honestly, I would rather have somebody probably guide me a little bit, at least at the beginning. But what I really recommend for your doing, if you are a beginning investor starting to invest, putting a little bit of money into an account, and I'm talking like 25 bucks, 50 bucks, whatever it may be, but putting a little bit of money into an account just to see what it does, just to get the feel for it, really just to get the diversification of the portfolio, but understand what it is while you're doing your research. I bought NVIDIA at 130. How long do you recommend I should hold? And which level should I take profit? Honestly, Kookie, there's a couple in one article that I'm going to be covering tomorrow. Two monster AI growth stocks to really purchase, and NVIDIA is one of them. Even working with a financial advisor, I know NVIDIA had a little bit of a pullback, but yeah, you can definitely take some, but it depends what you're looking to do with it. Because are you looking to take profits? For me, it's long-term, guys. These companies like NVIDIA, when you look at Apple, when you look at Microsoft, when you look at a lot of those, they are ones that are really the buy and hold. At a point, I don't know at what point I would be selling NVIDIA, just because when you start thinking big picture, they control roughly 90% of the chip market. They control a majority of, and again, thinking of income generation, they control a majority of cloud computing. They are going to be literally a monster for probably at least the next 5 to 10 years. NVIDIA, absolutely going to be. And Mike, yes, definitely. The VOOQQQM, the VGT, all three of those ETFs, I do personally hold. If you checked out my portfolio on M1 Finance, I hold VOOQQQM together with the SCHD. That is actually one portfolio, and that is my personal three fund portfolio. And looking at the growth aspect now, I am 45 years old. I hold 40% of that portfolio in that QQQM, 30% in the VOO, 30% in the SCHD, which is the portfolio. And then, of course, I do have a portfolio for my kids, which focuses in I think it's the VUG. I'm not sure I'm in the VGT, but also the VYM is in there. And again, I built the 3-fund portfolio for my kids. They don't know it yet because, they're still very, very young age, but putting consistent contributions in there every single month for them. When they hit the age of 18, let's say they need money for school, let's say even 16, they need money for a car, for anything of that nature, we are stockpiling money in there because, of course, they have another 6 to 8 years before that's even going to be a realistic contribution. But the last one that we're looking in here for really the beginner investors is consistency and patience. When you think about, again, the old quote, it is not about timing the market, it is about the time in the market. When you think of your working years, so let's say even 20 when you're done with college until now 65, you have a 45-year window that, of course, you can make contributions. You can also, diversify your portfolio, but you can also see the growth factor. They've done a lot of studies. We've seen a lot of things where if you start out at 18 to 20, putting 15% of your portfolio away, you're going to stay at that 15% for your entire life. If you think of 15% contributions, looking at, 30, 40, 45 years of working, 15% contributions, you're talking about job changes, 15%. You're talking about promotions, still staying at that 15%. Getting annual raises, staying at that 15%. So literally putting everything into there for the long-term game. And honestly, they said, looking at the different generations, and this was kind of interesting, looking at the baby boomers, they started investing about 35. So right there, you're looking about 15 years later. When you start looking at millennials, a little bit younger, then you start looking at the Gen Z. Gen Z is starting at 19. So with the ability of all of our applications, you have your M1, you have your Robinhood, you have, your Moomoo, you have all of these different investment platforms. Individuals are starting to invest at a much younger age, but they are not investing at the rate that they need to. They might be putting away, 1%, 3%. They are not investing. Even a lot of individuals that I work with are not even taking full advantage of the matching contributions, which is kind of crazy to think, because when it comes to getting free money, it is literally the easiest way to get free money is those matching contributions. Thank you always for making great content. Thank you, Kookie. I love it, guys. Most of you know, if you've watched my channel, if you watch my gaming channel, which I know a lot of individuals come from, I love doing the YouTube content. I am a certified financial counselor. I do this for a living as well as running a financial institution. It is something that I am passionate about, which is the reason why we did make the finance channel. Really the education piece. And I feel like the more information that I can put out there and the more kind of consistent and the more legitimate information, looking at a lot of different platforms, there can be some information that I see that really is very questionable or is just flat out wrong. There's a lot of things, again, that I kind of encounter where I have individuals that come out in and have conversations about investments from things they heard on TikTok. We see, people coming in and having conversations about things they've seen on Instagram on where they should invest. And I've also seen, kind of the darker side of it, where individuals have followed advice, over on TikTok, over on YouTube, a couple different places, and they have lost a ton of money. Putting money into cryptocurrency, putting money into things that they didn't exchange, they got completely burned. And again, I have seen it multiple times on both sides, not only one with the high interest debt that a lot of individuals have, but the other side is investing in things that they don't understand and they don't understand the risk. They see and they invest a little bit of money. It goes down. They pull all their money out. Never again, they're not investing anything else, which of course is the wrong way to set up investing. And also when you think about this big picture, looking at the family, having conversations about investing, having conversations about really everything financial doesn't happen here. Now, I live, just north of Detroit in Michigan. The conversation within families, even within your immediate family, but even the extended family, brothers and sisters, the conversation around money doesn't really come up. And it is so kind of taboo to have conversations, which I've already started. My daughter and I, which now she is 10, we were actually having conversations about interest, about investing. It's super interesting. The younger that they are, that you start it and really expose them to what it is. They have a really good understanding, even at a very young age. Do I think AI tools like ChatGPT can be good for doing research and analytics for investing? I do, but again, some of it I really feel like you have to take with a grain of salt, because if you see some of the bigger YouTubers and thinking of like an Andre Jink, looking at a few other ones, they have had, Copilot, they have had ChatGPT actually make portfolios for them. Some of the portfolios did well. Some of the portfolios really underperformed where it should have been. When you start thinking of investing, and I have gotten this comment with my investing portfolio, and I've actually heard this a couple times on this channel, is my investment portfolio is super boring, which is good. I love when people say that my investment portfolio is boring. When you think of the investment portfolio, I actually started in, I think it was 2021. Now, 2022, we've seen the market, of course, decrease about 20%, then 23, even 24. So you're talking going on 4 years in my investment portfolio. In those 4 years, I am up about 78% as of today, which is kind of crazy because, of course, I do dollar cost averaging. Now, if you're unfamiliar with dollar cost averaging, it is putting money in on a certain amount at a certain frequency. So for me, dollar cost averaging, I get paid every 2 weeks. Every 2 weeks, I put X amount of money into the stock market, and that is it. It is literally like clockwork. If the market is up, I'm buying less of my ETFs. If the market is down, I'm buying more of the ETFs. But now I'm to the point where the investment portfolio, and if you guys remember a couple months ago when it hit that 100,000 mark, which of course is what we're aiming for with beginner investors in this video. But once I hit that $100,000 mark, now it's at about 121,000 with the growth that we have actually seen this year. And of course, a lot of that is due to the first quarter we got dividends, the second quarter we're getting dividends, and now the dividends are at the point where it is making a difference, where the dividends that the ETF portfolios are pulling in are now, not just $10, not hundreds of dollars, but it's getting to the point of almost thousands of dollars every single time with the portfolio we have. So I love when those dividend payments come in. I believe the last one that we got for quarter number 2 based on the portfolio and buying was around, I think it was $800-900 in total that we got paid, which again, dividends, I get paid, they're reinvested automatically. So not only at this point am I making regular contributions every 2 weeks into that portfolio, continue to grow it. I also have the growth aspect, which I believe it was 13-14% this year, that we have seen the growth aspect. And then you throw in the dividends that are also rolling in there, and really the growth that we have with that. It's firing on all cylinders. It's doing incredibly well with a investment portfolio. And this is the point where, very similar to what we think of high interest debt, it really starts snowballing, and it really starts snowballing faster. If I have another 5 years, in 5 years, I can probably put, and I'm hoping to stay on track with where I'm at, about another $250,000 in this portfolio. With the growth factor, with everything over the next 5 years, it'll probably be north well over $500,000. And then, of course, that is where the snowball literally starts going down the hill. If you've ever taken a moment and pulled up a compounding interest calculator, it is incredible when you start seeing the growth and when you start seeing the multitude of years. And then, of course, when you think I have another, right now, 20 years, 22 years till technically retirement, full Social Security age at the age of 67. If I continue contributions like I do in this portfolio, we're probably looking at $3 to $5 million by the time that I would be essentially retired at 67, if not a little bit higher, because of course, this is just one really facet that we have. I have HSA accounts. We have MESP accounts for my kids. This is my brokerage accounts. I have 401ks. We have IRAs. My wife has 401ks. So we have a lot when it comes to the investment portfolios. And of course, this has taken a dedicated amount of time. And we really buckled down in probably about 10 years ago. We buckled down and said, we are eliminating debt. That is it, period. There is going to hit a point in your life, whether you're 25, 35, or 45, when you hit a point in your life where you no longer want to have debt, you no longer want the burden, you no longer want, the conversations or the arguments about paying off high interest debt. We even eliminated student loan debt. We eliminated high interest debt. We eliminated auto loan debt. We eliminated literally everything except the mortgage itself. And that's another video for another time, but paying off the mortgage versus investing, that of course is a very, very touchy subject for a lot of individuals. But for me personally, sitting at a 2% interest rate, there's not really a big need or really a big push to pay it off. There's a certain point, which I'm going to share with you guys within the next 5 years. So on my 50th birthday, I want to do a video. I want to do a stream. So 5 years later, again, thinking of a little bit of a fast forward, but thinking of 5 years later where I do want to do a video and I will pay off the mortgage in the entirety. So moving a little bit of money out of the investment account after that 5 years of growth, paying off the mortgage after making 5 more years of payment and being completely done. And then of course, we can snowball without a mortgage, without literally any debt whatsoever. This investment portfolio will just literally go to the moon because of being able to put so much money into it on a monthly basis, getting ready for retirement and really finishing it strong before we start the early retirement. Now, me personally, guys, if you see back here, it is the debt-free journey, and we are on the debt-free journey. Again, 5 more years of the house. I feel like I'm going to probably have to take 20, 30%, I'm estimating, out of my investment portfolio just to pay this off, to get rid of the house. And then again, I'm going to start putting all the money right back in there, and freeing up that cash flow is going to make a big difference. So, all right, guys, so that is going to do it for today's video. Thank you guys for joining me, Mike and Kookie. I love seeing all the comments in there. I love being able to interact with you guys, but definitely a couple very solid strategies for beginners to make that first 100,000, even making it the first 10,000. When you start setting those clear goals, it makes a difference. Write them down. Put a time horizon around them. Know exactly how much time you want to hit that goal. If it is about paying off that high interest debt, being debt free, what does the time frame look like? Make sure it is realistic. Make sure that it is relevant, that are within the SMART goals. Make sure that you're eliminating the debt, because when it comes to debt, like we said earlier, it is the absolute most expensive thing that you will ever carry in your life. Far more expensive than cars and homes and student loans. High interest debt is an absolute detrimental thing to not only your finance, but also your financial well-being, because of course, credit cards and the debt that they carry are going to tank your credit score depending on where you do have the balances at. So again, guys, that is going to do it for our stream for today. I'm going to try to do this once or twice a week. I love doing the streams. I love being able to talk to you guys. Thank you for all the questions and the interactions today. So guys, I will catch you guys in the next stream, and thank you guys for watching.